You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That distinct lack of music for the live folks means we are diving on into the crazy fun waters known as TWIFO. Indeed, the portion of the program where we break down, really on the network here, where we break down what's going on the other side of the trading fence. Yeah, we're going to talk the futures options. So who knows? Maybe some metals, maybe some equity vol, maybe some ags. You really never know. We ran the gamut last week when Eric was on. We kind of hit on every product category. And that's the case whenever Eric and the research folks come on, because they always have research touching on everything under the sun. So that was a fun one. Check it out if you haven't already. And you guys know where to go. If you want to join the fun secret handshake club here, theoptionsinsider.com/pro is the place to go to begin your journey to the dark side. But shh, it's a secret. Don't tell anybody. As we keep on rolling here, let's kick things off. And who's joining me today? Well, we are joined once again by the uncleest of Mikes, Mr. Uncle Mike TOSAW from St. Charles Wealth Management. Uncle Mike, welcome back, sir.
Always a pleasure to be here.
So, Mr. Uncle Mike, guess what? You get to squeeze into both chairs. You have to jump back and forth. Can you handle that, sir?
I can do so. It's an honor to do both, to be part of the FTSE Russell hot seat as well as the CME hot seat. It's quite the honor and privilege.
All right, as we keep on rolling, it is time to kick off the show the way we like to do. It's time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers. This is indeed the portion of the show where we break down what were the biggest movers and shakers, what's moving to the upside and to the dark side there at CME this week. If you'd like to see this chart for yourselves, head on over. Just give them a follow on Twitter. CME Group is their handle there, and they like to tweet this chart out. We always do as well. So you can get a chance to see this before showtime or afterward if you are indeed intrigued by a lot of green on the screen. I'm going to give you a spoiler today. But Mr. Uncle Mike, sir, where should we begin our journey this week? To the light side or to the dark side?
I'd always say to the light side. I'm not a dark sider.
No, you're not. I had a feeling you were going to go this way. And it is the right choice this week, sir. Not a lot of dark side. In fact, I think there's barely a bottom 5 we could make, and that's about it. So we'll save those for now. It's a green week on the screen, listeners. It's so green that, in fact, the 2.25% rally for the Russell 2000, that only puts it down at number 10. That's how much green is on the screen this week, listeners. Let's go out to our actual top 5. Number 5, we've got KC Wheat. So back in the ags, listeners, up almost 3.2% this week for number 5. Number 4, we're going back out to the metals, not precious this time. We're getting industrial with copper up nearly 4%, 3.96%. Number 3, soybean oil up just a tick over 4%, 4.05% to be precise. That's good for number 3. It was number 3 in the other direction last week, listeners, off nearly 5.4%, or about 5.4%. And it does some paper. It does about 57,000 contracts, so we could maybe hang our hat out there. Numero dos here. Once again, back to the metals. It's palladium, up 4.6%. And number 1 with not just a bullet, this is a freaking cannon. It's Bitcoin, ye old BTC, up 23.37% out there, listeners. Last week, it was number 3, up a paltry 2.9%. So a little bit different movement rate this week versus last week. Of course, Bitcoin getting a huge lift out there from a bunch of different fronts. It had broken the 30,000 handle before this rally began, and now it got up and broke the 40,000 handle in the other direction. So huge swings out there in Bitcoin. If you're intrigued by all that, of course, I encourage you to check out our crypto rundown program. We do that every Monday after the option block. A lot to parse there. We broke down all the vol, the skew, the OI, all that good stuff, and a whole bunch more over there in all things Bitcoin. As we head on out now to the dark side, let's explore the darkness for ourselves, listeners. Number 5, platinum. Once again, out to the metals, off 1.3%. It was number 1 to the dark side last week, off nearly 7%, 6.6%. So it's been a rough couple of weeks for platinum. Number 4, back out to the ags. It's corn, off 1.37%. Number 3, we're going back out to the Nikkei, denominated in the yen there, off 1.38%. Just a tick past corn to the dark side there. Number 2, soybean meal, off 1.51%. And the number 1 dark side mover this week is lumber, off, at least for lumber, a comparatively nominal 4.95%. If you're wondering, last week, it was number 1 in the other direction. It actually beat Bitcoin. It was up 31.65%. So the only thing that can eclipse Bitcoin these days in terms of vol and in terms of movement is lumber. This week, though, having a bit of a quiet week, off 31.65%. But Mr. Uncle Mike, you're doing double duty, holding down the CME and the FTSE Russell hot seats out there today. So I will leave it to you. Does something on our movers and shakers list draw your eye, or is it perhaps something else? Where should we begin our futures options journey this week?
Well, you made the mistake of giving me free reign like that. So you know what I'm going to do, Mark? I'm going to do something I've wanted to do for almost 20 years. I am going to jump on the boat with a 10-year note.
I had
what
a
do you
feeling
think about that?
I had a feeling you were going to do that. You're playing the Russell Rhodes role. Whenever he comes on the show, he likes to jump into rates. So I guess it's that time, listeners. It is time to explore the world of rates.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
So, right now, with where we are with option volatility in the bond world, it's actually ticked up a little bit over the course of the last couple of weeks. Frequently, what I'll do is I'll sell premium 1 to 4 weeks out on the treasuries. And so in looking at that, the 10-year note is obviously the the benchmark in the bond world. It's like the S&P 500 of the bond world. And so what I like doing for a lot of my financial clients is the big thing out there right now is that people are saying, well, I can't get yield anywhere, so I have to buy longer term bonds, or I can't get yield anymore, so I have to buy junk bonds, or if you're a bond wholesaler, you call them high yield bonds, whatever way you need to do it. But what I think makes a lot more sense at this point in time is the fact that you can sell premium and hold the bond itself. So let's say that you wanted to 10-year notes, roughly the futures contracts at roughly 133, something around there. So if you wanted to just hold that and you wanted to collect income, or I'm sorry, it's at 134. If you wanted to collect income, you have the ability to do that. Now, people initially, if in the investment world, will say that, well, I don't want to hold the 10-year note. Why on earth would I want to wait 10 years on something that has a yield of 1.3% or 1.2% or 1.5% even? Why would I even want to mess with that? Just not even worth my time. Well, I would say that if you are looking to do something along those lines, personally, as a financial advisor right now, I have very minimal bond holdings. I mean, I do have some municipal bonds for certain clients in certain states, and I do have there's a few things with which I'll do, but the primary source of my bond allocation as a financial advisor is in the treasuries. And so you might be saying, well, Mike, holy cow, you really are just doing your clients a disservice. Why are you giving them that with such anemic rates of return? And that's a very valid question. If you tune into the financial news media, they'll talk about how evil, horrible, awful, and bad bonds are right now. But I actually feel that they're a good spot to be if, and this is a huge if, you're using options. So, for example, let's say that you're in the 10-year note. It's at 134 right now, approximately. And I'm talking about the futures contract. If you're just in the futures contract, you're not going to collect on the 1.3% or 1.4%. Excuse me. I need 1 second. I apologize.
No problem. That happens to me when I talk about rates, too. I get all choked up, sir. There's just so much action out there in the world of rates. While we're waiting for Uncle Mike to gather his thoughts there, you guys know where to go, listeners. If you want to play the rates home game for yourself or pretty much any other product we're going to break down on the show today, cmegroup.com/TWIFO, TWIFO, or /TWIO, TWIO. That's This Week in Futures Options or This Week in Options. Both of them should work. Keep the caps off. Keep the caps lock off. For whatever reason, that URL does not like caps. If you put it in caps, it will not work. But TWIFO or /TWIO, that'll get you to all these reports. If you want to see what Uncle Mike is talking about, head on out there to, of course, interest rates. Then go to U.S. rates and pull the drop down to the 10-year note, TY out there. And that'll get you what you need to see. I like to hit select all, just be forewarned. That's a little bit of paper. By the way, speaking of paper, the 10-year note, no slouch in the paper realm. Almost 1.5 million contracts on the tape right now. So a lot of paper going up out there. Mr. Uncle Mike, how you feeling, sir? Have you recovered your sanity, sir?
I don't know if I'll ever do that, but I think I'm ready to continue nonetheless.
Right. Well, you chose rates, so your sanity is questionable, but I digress. Have at it, sir.
It is. So with this, you have your choices out there as an investor of how you can invest. And so, like I said, primarily bonds are not very popular right now because the risk of the bond value itself going down is very real, and the money that you're going to make on it, it's not going to be that much. And let's say that we do have just this rush to safety. Let's say the stock market crashes and we have this rush to safety. Bonds still aren't going to go up that much. So it's kind of one of those things to where it's kind of a concern for a lot of financial advisors right now. And so the first thing that a lot of them do, which quite frankly drives me insane, is that they will do some of the tactics that I talked about earlier of putting people into lesser lower rated bonds, aka junk bonds or longer term bonds than they really should be in. But what I've decided to do with this is I have people in treasuries and I like to sell premium on it. So let's say, for example, I've done the math on this. If you were to sell an at the money covered call on the 10-year note over the course of a year, you can probably, and let's say that you took on absolutely no margin whatsoever, then you can actually create, and let's assume that the prices stayed the exact same, you can create a yield of 5 to 7%, assuming you had absolutely no movement, assuming that the prices of the options stayed the same every week. Now, is that what I'm advocating that you do? Absolutely not. I don't do just that, quite honestly. So, but with that, you actually have the ability to where you can get an increased yield, but you get the yield through the covered call premium. And I do this similar to just doing a wheel trade, to where if you get called away, you can just sell a put for the next week and you have the synthetic equivalent, and then you have that. I do this on weeklies. I'll do it on monthlies. Sometimes I'll go out a little bit further. It just kind of depends on what the market gives me and where volatility is at the time. And so recently, over the course of the last week, we actually have had a little bit juicier options in the treasury space. Now, you might say, well, but Mike, that's all fine and good, but let's go back to 1982, Mike. Let's just say that we have inflation. We have inflation really, really bad. If we have that, well, if that's the case, then the other thing with which I've done for my clients is I've bought some garbage. I love buying garbage, quite honestly, for a few pennies or a few ticks, depending on whatever you're trading or what instrument you're trading. I've actually bought put options roughly a year out. It's not a year anymore, but roughly a year out at the time I did it, to where if we have a approximately 12 to 15% drop in the, not the yield, but in the underlying itself, then I'm hedged. And it took me I sacrificed roughly 2 weeks of option premium to have that hedge. So let's say, for example, that all of a sudden we are just deciding that inflation is just through the roof. We are really concerned. We're going back to 1982 and interest rates just go through the roof because of the fact that we have to control inflation. And so we're controlling inflation because interest rates are way up. There's such a rush to the stock market that the bonds just get sold. And I mean really sold. And let's say, like right now, for example, the 10-year note is at 134, and I really want to just have a sell-off on it. And then now all of a sudden it is at 60. I mean, we just go down because of the fact that we are just having so much inflation. You can buy CDs at a bank now for 11 to 12%. Let's say that we do that. Well, if I don't have that catastrophe hedge in place, then the safe investment that I promised my clients, my name is Mud. I am just a flippin' idiot for putting them in that because, Mike, wait a second. I thought this was supposed to be the safe part of my portfolio, but now all of a sudden I'm down 40% in government treasuries. Holy cow, you're an idiot, Mike. Those are the types of phone calls I would get. I don't like getting those phone calls. So what I've done is if you go out a far enough amount of time and you actually can buy a put option 10, 15% out of the money, it's going to be garbage. It'll likely never be used. But if you have the ability to do that and you want to hedge this against some actual treasuries that you're buying from treasurydirect.gov, or you just want to hold the note itself and maybe not have any leverage on it on the future side of it, whatever the case may be, whatever way you want to set it up for getting income, you have that protection in place. And so what I really find fascinating about all of this is the fact that I've not heard on the general financial news media, I have not heard one person talk about how you have the ability to sell premium on treasuries and then have the risk of a government treasury. You can even hedge it if you want to be extra careful like I've been. If you don't want to be careful, that's fine. It's really not an extreme amount of risk anyway, just to hold U.S. government treasuries. But you have the ability to create some yield. I've heard one person even tell me about this strategy in my nearly 20 years in the business. And that person right now is actually, he's been a good friend of ours. He's been a co-host with us on another show, and that's the Viceroy. He described to me one time, I asked him about it, and he said the only people that he knows that really do this are the billionaires that want to create a little bit of extra yield that he knows of that do this. and that want to have a little bit more juice, so to speak, in their treasury holdings. And so what I say is that if you want to have bond allocations, which most people should, whether it's a little or a lot, but you're really disappointed about where bonds are, that's what I'm doing right now. And I feel that the yields of what you can get, comparatively speaking, from a risk reward standpoint to corporates, to municipals, I feel it's in a phenomenal place right now if you're using treasury premium selling.
Well said, sir. Let's see what the numbers are showing us out there on CME. Remember, cmegroup.com/TWIFO, listeners, is the place to go. Go out to the drop down, go out to the 10-year note. As Uncle Mike likes to say, we're getting on the boat with the 10-year note. If you do that, you'll see coming into showtime, we saw the 10-year note at about a 134.065, up slightly on the week. Not a huge mover this week. The Fed didn't really juice much action out there, at least from a net movement perspective. In terms of paper, though, like I said, a lot of paper lighting it up out here. Nearly 1.5 million contracts going up. Of that, looks like the SEP contract is where the lion's share of the action, about 54% of that, about 1.5 million contracts going up out there in September. So we're going to hang our hat out there. By the way, try not to laugh when I say these vol numbers, because you're probably used to equity vol and maybe some of the ags or other products that are very volatile these days. Bitcoin, certainly. Volatility in the SEP contract on the 10-year note, listeners, a rousing 4.28, off about 0.2 on the week. So longer-term treasuries, not usually the place you go for a lot of rock'em sock'em robots volatility. Let's look at the skew out here, see how that's lining up. Last week, the puts 3.4% rich to the at the money. This week, nearly 5%, 4.8% rich. So the puts getting bid up a little bit. That doesn't sound like a lot, but for the treasuries, that's actually a pretty substantial skew shift. In terms of the calls, last week, 3.1% cheap. This week, 1.7% cheap. So calls getting bid up a little bit. Puts getting bid up a little bit as well, which is intriguing out here. And in terms of the most action out here, which is probably why we're seeing that change in the put wing, the most active contract out here in the 10-year this week, the 133 even puts with nearly 100,000 contracts, 95,339 contracts on the tape this week. The most active day was yesterday, almost 35,000, 34,968 to be precise. Looks like a good chunk of that closing coming on the heels of all that Fed talk earlier, followed by Tuesday, 31,384, nearly 20,000 on Monday, and about 10,600 on the tape today. So again, nearly 100,000 contracts just in this one put in this 1 month out here. That's going to be more than some of the complexes we'll talk about later on in the show, listeners. So a lot of action out here, even in an otherwise somewhat quiet week out here in the rates. Followed by number 2 out here, listeners, was the 132 puts with about 75, almost 76,000 contracts. The most active day, once again, Wednesday, about 34,000, slightly biased towards closing, followed by Monday, 19,000, and Tuesday, 16,000. Only about 6,300 going up out there today. So put action out there in September. These contracts have about almost 30 days to go out there. So effectively monthly puts lighting it up out here in the 10-year. Not exactly surprising. It's probably what most people expected given what we had going on out here this week. Uncle Mike, any surprises for you on this? It is mostly near-term downside puts lighting it up out here in the treasuries, or anything else surprising you out here in the vol or the skew? And what are your thoughts on these vol numbers when I'm quoting effectively a 4.25, sir?
Yeah, in terms of the vol numbers, it's the 10-year note is not where you go if you're looking for a lot of volatility. That's for sure. So no surprise. My personal sentiment, I think we are slightly overbought right now on the 10-year note. But I think that with where we are, if it does come down a little bit, and I'm doing my wheel trades, if you will, in there to where I'm still short puts out of the money at this point in time in the 10-year note, or on my option treasuries or my treasury bonds with which I'm using. It's not just the 10-year note, but I think that with where we are, the Fed announcement was a resounding meh, as you would put it. And it's not surprising that it was a resounding meh, because I think people were expecting it to be meh. But in case it wasn't meh, that's the reason we have the major volatility with which we've had in the 10-year note this week.
All right, so that's going to do it for the rates out here. Mr. Uncle Mike, you're still in the driver's seat. Like I said, you are straddling both the CME Group and FTSE Russell hot seats. So where should we bring our TWIFO action, our eye of TWIFO, sir, if you will, next?
Well, I mean, I'm more than happy to talk a little bit about silver, if that is okay with the boss of the show, and that is you.
Well, since you mentioned silver, I was going to save this before we get to that, let's just play the little introduction now. It is time, listeners, to head on out into the land of metals.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, everybody. Uncle Mike, since you mentioned silver, I'm going to bump up this listener question for you as well. We have a question here from Emmanuel. He wants to know, where is Uncle Mike on silver at these levels? Is it still collar worthy? So, and of course, listeners, if you want to play along to the home game, head on out to that same report, cmegroup.com/TWIFO. You're going to back out of the rates now. You're going to go into metals. You're going to go on out to precious. It's the second one down there on the drop down for silver. And then you'll have at it, you'll see that actually on this week, silver up nearly 2%. So having a nice little pop here since Monday. Uncle Mike, what are your thoughts on silver, A? And then B, as Emmanuel wants to know, is silver still collar worthy at these levels, sir?
Well, I'll for sure say it's collar worthy. I'll do B first, then A, just because of the traditional reverse skew that exists in the silver, to where calls are typically priced more than puts. I would say it's almost, until that changes, I think it's always collar worthy, just because of the favorable risk reward you get when doing so. Meaning that, and I talk about this, I think, every time I'm on TWIFO, is that you can sell a covered call, you can buy the underlying, sell a covered call further out of the money than the put would be. So, oversimplified example, silver's a 22, let's say. You could likely sell normally the costless collar, you'd sell the 24 covered call and then buy the 20 put. You might be able to sell the 25 covered call and have $3 of potential upside and only $2 of potential downside for a zero cost. Does that happen every time? No. I just totally made up those numbers, so don't buy anything into them. But that's the general concept of why I'm really attracted to doing collars on silver. With that being said, where I'm looking at right now in terms of where I like silver, I think it's towards the lower end of its range. If you look at it, it's been fairly range bound over the last year or so. And I think that with it, the silver typically comes like a thief in the night when it has its upside. So, for example, if you look at it in, I believe, late January, early February, you see the spike up with which it had, and then it kind of came back down. Silver, it's kind of like running the triple option in football, which actually for us, that should be our favorite offense. Now that I think about it, if we're option guys. But it's kind of like that in that they'll bore you to death running the dive every play. But then once you get bored and start thinking, okay, it's just boring. It's just boring. Then they throw a deep pass and surprise everyone and score a touchdown. Silver kind of works the same way in that it's going to bore you to death most of the time. But when they throw a deep pass, it'll be when you least expect it, and it comes like a thief in the night. And so where I'm at right now with my silver positioning, going into this year, what I did was I sold a put spread with silver being in roughly the mid-20s, I believe it was back in January. I'd have to look at the chart to give you an exact number, but it was in about the mid-20s. Sold a put spread about $5 out of the money. So I had a $5 distance between strikes. And my thought was that if silver did go down $5, I'd want to own it anyway. I had the hedge on there just in case it went way down, but I would have been more than happy to, and still would be more than happy to buy at those levels. And with the premium that I collected from the put spread, what I was able to do is buy a call spread with a similar amount out of the money, with not a $5 difference between strikes, but a $13 difference in strikes, to where I'm risking 5 to potentially make 13. And that's what really attracts me to silver. It's not a collar, but I set up kind of a collar-esque risk reversal. And by setting it up that way, my risk reward was, like I said, a maximum downside of 5 with a maximum upside of 13. And the distance between the strikes was identical, $5 each way. And so by doing that, time decay has done its thing. And so recently, about 2 weeks ago, I actually bought to close the out of the money call for just a few pennies. So now what I do is I have just a typical risk reversal play, but I have $5 of downside risk. If silver does come like a thief in the night over the course of the next 5 months, I have unlimited upside, and all of this cost me just a few pennies. And so I really like silver because you can do a lot of fun things in the option world like that, to where you have to catch it, because if you don't catch it when it comes like a thief in the night and you don't sell, it'll go right back to running the dive in football, so to speak. But if you have the opportunity to catch it when it goes higher, it can be very lucrative. The best one that I can think of was roughly 10 years ago in 2010, 2011, when silver was up in the 50 range. That was very exciting. But then it came down, and that's what silver does. It's boring for a long time, and then whenever you least expect it, it comes up high, it comes up fast. And so that's kind of my view on silver now, and it has been for quite a while.
In case you can't tell, Uncle Mike likes himself a wee bit of silver. I had a feeling silver was going to sneak onto the show today. Let's head on out now, see what's lighting it up out there on CME from a silver perspective. Again, a little bit lighter volume product compared. We're just talking 1.5 million contracts for the 10-year and almost 100,000 contracts just in those at-the-money puts. Silver, the entire complex right now, almost 31,000 contracts. So a little bit lighter volume product. Still one of the heavier volume metals out there. Metals don't blow the doors off when it comes to overall volume. If you're wondering of that paper, it looks like about 2/3 went up once again in the SEP contract. So SEP dominating the tape out here in silver as well. Coming at showtime, silver at about a 25, almost 3/4, about 25.72. Like I said, up nearly 2% on the week. So a decent week here for silver, heading on out to this SEP contract. The vol out there, again, a little bit different story than the rates. The vol and the rates, where we're talking about a 4. Now you're talking about a 25, almost 26, about a 25.65, up about 1.5 points. So vol getting a little frothy out there in silver land this week. Let's look at the skew out here in September. The puts last week, nearly 3% cheap, 2.8% cheap this week. They've got a little bit of that bid back, about 2.1% cheap. So slowly but surely coming back to their former gusto. The calls last week, 4.7% rich. This week, 6.5% rich. So the calls getting a little bit more juice in them, as well as the vol is kind of lifting across the board here. And in terms of where the action was this week, this seems like a ridiculous strike. So I need to just let me just make sure this is correct, Mr. Uncle Mike. This is funny. All right. So if you had to guess, sir, what the most active strike in silver options was this week, it was in September. I'll give you that. And I said we're at about a 25, almost 25.75. So if you had to guess what the most active option in silver was this week, what would probably be on the top of your list, sir? Give me a couple.
Top of my list, 25 call, 26 call, 23 put. Those would be my top three.
I noticed the SEP par, aka the SEP 100 call, was not on that list, sir.
No, it was not.
Well, that's what was
that
the most active.
That person really believes in the thief in the night.
That was the most active contract this week. The SEP 100s trading pretty actively, actually all week. 1,500 total, about 6,000 of these things traded this week. 1,500 on Tuesday, only 5 on Monday. 1,792 on Wednesday, and nearly 3,000 today. And all of that, of course, opening, because there's no eye on this strike. So nearly 6,000 listeners of the pars in September have traded. That is insanity here. I need to get into this a little bit more. This might have to make a return appearance on our options oddity show letters. This is almost the definition of odd paper. And by the way, it's not the only month where the pars are trading, listeners. The D's pars also traded nearly 1,000 this week as well. Most of that on Wednesday, 598. So it's not quite a roll. Why you'd be rolling the par strike right now, I don't know anyway, but that's a conversation for another day. It's not a sept D's roll or anything along those lines. It's just action opening paper in both SEP and D's on the 100 strike in silver. That is absolute madness. That reminds me of earlier this year when we saw all this talk. Oh, here comes the silver squeeze. Here comes the silver squeeze. That's the kind of paper you'd expect to see if there was indeed a silver squeeze. I need to parse it a little bit more to see if we can get some insight into what they were doing out there, and go out on a limb and say they were probably buying these, because that seems to be the order of the day. And all the precious metals folks love to do crazy upside buying trades. I don't see anything that could even be remotely considered a spread. The 50 strike was trading a bit, but it wasn't anywhere near one, even 2 or 3 to 1. It was 785 of the 50s traded this week in September as well. So they could be doing a very funky 50 par ratio. But I don't know, Mr. Uncle Mike, when I started parsing silver today, I did not expect to be talking about September 100 calls, sir, but that's where we are, sir.
Hey, that makes me happy. I hope he's right. There's going to be a whole lot of grinning going on, mostly by me, if we actually get up to 100 by September. And so,
yeah, you may want to start take another look at the upside of that collar, sir, because you may need to roll that hard if that par strike is coming into fruition anytime soon. This almost looks like it's not an error though. I've checked it twice. This is definitely real paper. Someone was trading the SEP pars hot and heavy this week, listeners. Yeah, this needs more attention than we can give it right now on the show. We'll come back to this, maybe on Options Oddity, so those folks in the cool secret club on the pro side. I think we need to talk about this a little more, because this is fascinating paper. As we keep on rolling, you know what else is fascinating, listeners? It's some volatility, so let's get to it and talk a little bit of the equities.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, let's do it. Let's talk some equities. I think you guys got a little bit of the music there on the live. Let me know if that worked for you. I think it's all set up there now, so you can enjoy some of the fun transitions on the live front, even from here in the Southern studio. Again, you can't talk equities without talking the other side of that coin, which is volatility. And coming into today's show, most of that vol is, spoiler alert, it's lower than it was this time last week. RBX, which is the VIX of the Russell 2000, just a tick under 25. A 24.90 coming into showtime puts it off about 1.2 points from where it was this time last week. VIX cash still hanging out around that 17.5 level. That's effectively unched from where it was last week, slightly down since it was this time last week. VVIX, which is the volatility of volatility, at about a 113. That puts it down nearly 6 points. So the vol of vol coming in quite a bit from last week. And VolQ, a.k.a. the at-the-money vol of the NASDAQ 100, a.k.a. the newest tradable volatility product over there at CME, at about a 1660 coming into showtime. It's down about exactly half a point from where it was this time last week. So that puts the VIX to RBX spread, a.k.a. the small cap to large cap spread, at about 740 or so. It puts it about exactly a point tighter than it was this time last week. And the VIX to VolQ, so the S&P 500 to NASDAQ vol spread, at about almost exactly a point. That's about a third of a point wider. So that's kind of widening it out. If you've been listening to the show for a bit, you know that's kind of been hanging out at the sub 1 level for a little while, and that's kind of unusually tight for that spread. So before I keep on rolling, Mr. Uncle Mike, I know you like to hang your hat in a little bit of the equities. What's lighting up your tape out there, I should say, from an equities and a volatility perspective this week, sir?
Well, in looking at on the equity and the volatility side, of course, the S&P 500 or the E-mini, whatever way you want to look at it, new all-time highs today. So that was pretty exciting, showing the current contract at 1414. I'm sorry, 1414. That would not be an all-time high. 44.14 half. High of the day is 44.22 on the S&P mini. So watching that, seeing where we're going with it. I think that 4,300 was kind of a tough nut to crack. And so now that we're well above that, it seems that we're continuing to just go higher. We're above 4,400 now. We've been kind of tinkering around that number for a little while. We have had a 40-point range today, if you want to include the early morning trading before the cash markets opened. So we are getting a lot of movement. And so in looking at this, we do have volatility coming down a little bit. It'll be interesting to see how it goes for the weekend. And I think that with where we are with going to new all-time highs in the S&P 500, at some point, I would think that implied volatility would go lower. We talked about it a little bit on the last show in terms of how we had very low volatility in years past, but now, even though we're at all-time highs, we've been at all-time highs for a while, we've been making all-time highs for a while, but we still have volatility at much higher levels right now. And the reasoning is that there's still a lot of fear out there, quite frankly. And so we're not getting the days as much as we have in years past of where if the S&P 500's up 1% and the VIX is down 10% and vice versa, we're not getting quite that 10-to-1 correlation as often as we did in years past. We are today. We're pretty close to it. But in years past, it would happen much more frequently. We are getting a lot more higher vol, higher markets, lower vol, lower stocks. And so when we get that, volatility is likely not going to come down. And so don't get me wrong, I love the days of when we would have single-digit VIX, but we're just not there right now. So that's kind of what I'm seeing right now in the equity space.
And let's see what we're seeing over there in equities. You guys know what to do. Go to that drop down, go back out to equities. Since Uncle Mike's an S&P guy, we're going to hang our hat out there first. Let's go to the E-mini S&P 500. That does a little bit of paper out there. About 1.5, almost 1.6 million contracts on the tape so far this week. So it does a little bit of action out there, listeners. Unfortunately, as it is with most equities, the lion's share of that, 27.5% of that, going up in the contract that expires tomorrow. So kind of hard to parse that from a vol and from a skew perspective. So we like to compromise in the equities. We like to usually go out 2 weeks whenever possible. Can't really do that in the equities, so you got to go out about a week. So let's go out to the contract expiring in 8 days. That has about 12% of the paper going up this week. The vol out there, such as it is about a 10.5, listeners. So getting kind of light out there in S&P land. It's off about half a point from where it was this time last week. Skew-wise, last week the puts were about 20.5% rich. This week, nearly 29%. So those puts getting juicy out there. Even though the vol overall is lower, the bid to the put wing in these weeklies is getting, shall we say, pronounced. 29% almost, 28.8%. The calls last week, 13% cheap. This week, 15.5% cheap. So calls getting cheaper, puts getting bid up here. In terms of where the action was out here this week, the most active contract, we do have to go back out to the contract that is expiring tomorrow. We're at about a 44.15 right now, listeners, to give you some frame of reference where we are in this E-mini S&P. And the 44 half calls were dominating the tape out here this week. 23, almost 24,000 of those going up this week. The lion's share actually yesterday, about 11,500 yesterday. About 70, a little over 7,000 actually today, and the rest kind of scattered throughout the week. So that was our clear most active contract, followed hot on its heels by the 43 half puts, doing 19, almost 20,000 contracts. The big day was Tuesday with about 8,500, followed by Wednesday with about 6,000. Again, most of those days opening out there. So a lot of very near-term paper out here, but we're looking at equities. And Uncle Mike is holding down the FTSE Russell hot seat. So let's switch out there really quick as well. Go on out to small caps. You know the dance, listeners. Go on out to the E-mini Russell 2000. From that drop down, we can hang our hats out there. A little bit more vol to be found usually in the small caps, which is what makes them attractive from an overall equity option and indeed a volatility trader perspective this week. Coming into showtime, we're seeing the small caps at about a 22.41. That puts them up about 36 handles or about 1.6%. So a nice second half of the week here for the Russell 2000. Again, same deal as with the S&P, 31% of this paper is going out tomorrow. So we have to roll out a little bit farther out. Let's go out again. Actually, we can make it about 22 days if we're diligent. That gets us to, with about 15% of the paper, that gets us to the week 3 AUG contract. Has about 22 days to go. The vol out there, 21.25. So again, a little bit juicier, listeners, even though it's off almost a full point from last week. So we keep wondering, when will RVX break the 20 handle? And some of these contracts going out nearly a month now are getting close to it, 21 and change. Remember, RVX is a 30-day measure of volatility. So it'll be interesting to see. We're hovering in that mid-20s range now. Can it break the 20 handle? Probably won't happen next week, but if what we're seeing out there continues, then perhaps we might see that vol continue to erode. Skew-wise, puts last week 14.2% rich. This week, 13% rich. So puts actually coming in a little bit in that contract out in August. And the calls last week, 10.6% cheap. This week, 12.2%. So the calls getting a little bit cheaper. In terms of the most active contract, is it the small delta calls this week? It is. The 2,500 calls in September is the number one trade out here this week. So you know what? Looks like maybe some of those small delta call players are actually back. Looks like most of that paper going up on Wednesday. All of that opening for the 2,500. No other spreads against it. And that's not rich enough for you, listeners. Also in D's, the 24 half calls also trading pretty actively out here this week. Pretty much all week long, the 24 halves were kind of active. So you know what? Didn't seem like it looked like the 2,200 calls were leading it, but if I scroll a little bit farther down, it actually is the small delta calls that when Matt was on here, he was talking about, when Russell was on here, he was talking about. It does seem like some of that fixation to the upside in the Russell 2000, after taking a bit of a break for a couple of weeks, maybe back with a gusto. Mr. Uncle Mike, did you spend a lot of time watching small caps? And if so, anything lighting up your tape or perhaps surprising you from some of these numbers that has broke down, sir?
I mean, I don't spend a lot of time looking at the small caps that much. I am more of an S&P guy, but within the Russell, not a ton of surprises. I think it just is a general rule of thumb is that you are going to have more movement, more volatility in the small caps than you typically will in the larger markets, just because of the fact that smaller stocks can have more good news and more bad news that'll affect a greater price difference at those levels.
All right, we're kind of coming up against, it looks like the weather is starting to move in here in the southern studio as well, so I don't want to get knocked off the air by a sudden raging storm. So let's keep on rolling into your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/the Options Insider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. Let's go out to the live secret club first, out there to the folks in the live chat. We got Nichols. Uncle Mike, you were talking about fixed income earlier. Nichols wants to know, what are some fixed income ETFs that Uncle Mike likes? A lot of our listeners, they love to listen to what's going on the side, but sometimes they prefer to replicate that in an ETF, sir. So if there are any that you like, Mr. Uncle Mike, have at it for our friend Nichols and everyone else out there who's listening, sir.
Well, some of the more popular ones that are out there, SHY is an ETF that tracks 1 to 3 year government treasuries. It never moves, and if you need to sleep at night, I would suggest just looking at a chart of SHY. It really doesn't move. But it does pay an anemic dividend of, not dividend, but does pay an anemic yield, but it does exist. There's also IEF. IEF is an ETF, say that 10 times real fast, that tracks treasuries on 7 to 10 year U.S. government treasuries. And so the movement on that is going to be fairly similar to the 10-year note. You can use that as well. And both of those are pretty, and the ones that I'm mentioning are very liquid on the ETF side of it. The options, and there are options on SHY, but they're not the most liquid to say the least. IEF, you're still going to have options on it, and if you are going to use the options, I don't know if I would necessarily be an option buyer in IEF, but if you want to be an option seller and allow them to expire worthless and understand that you're not going to get a lot of good fills on these if you try and be more active in them, IEF could be a good thing for you if that's what you're looking to do. There's also TLT. TLT tracks U.S. government treasuries that are 20 years or greater. TLT does give a pretty significant amount of movement, and options are very liquid. They're the most liquid of any of these three for liquidity. And by using that, you're going to get that type of movement on there that you may need or may want. You'll be able to get into and get out of option trades pretty well in terms of the liquidity that's there. So TLT also exists. If you're looking for corporates, there is LQD. LQD is an ETF that tracks corporate bonds. I believe, and I don't have any exposure to this right now, but I have used it in the past. I believe they are all investment grade corporate bonds. So it's triple B or above. Don't quote me on that. It's been a while since I've used this one. But you do have that one. Option volatility, where they do have weeklies. The liquidity in these, it's not what I would like it to be, but it's still not bad for where you're at, depending on what expiration you're trading and where you're going to be with it. So those are the ones that I look at that I would use or to take a look at if you're looking to invest in those spaces. There are junk bond ETFs as well. I believe HYLD is one of them. I don't touch that with a 10-foot pole, just not my style of investing or trading. And there is another one I don't know if off the top of my head. So I think it's JNK. I'm not 100% on that. Either way, I don't use those. And so in terms of corporates and treasuries, those are probably the main go-tos that I look at.
Well said. Great question, Nichols. If you want to join the secret club, get your questions bumped to the top of the list, you know where to go. theoptionsinsider.com/pro. As we keep on rolling, we got one more here. This is actually a very timely one. Just a great handle, very, very elegant handle. Elicias de Brazil says, hello. I am very much enjoying this week in futures options. Well, thank you, Elicias. Says, I have a question. Do you follow a lot of international action in the commodities that you break down every week on your program? Many of these products are primarily used, produced, or consumed outside of the United States. Thank you very much. Well, a great question, Elicias, and a very timely one. You'll see why in a second. But yes, we do pay attention to that. In fact, those are stats that CME likes to keep an eye on as well, because they have their trading. Obviously, there's a lot that goes on outside of the U.S. hours. And those markets you are referring to, and a lot of the paper we're talking about, a lot of the consumption, the use case, refining, production, whatever it is, a lot of the end users for these products, you're right, are international. So that is driving, even if we don't explicitly call it out on a show day to day, a lot of that paper we're talking about is being driven by international clients and international customers. So it's all kind of baked into the show every week, regardless, even if we don't specifically call it out. But the reason why I say your question is very timely, Elicias, is because right before showtime, our friends over there at FIA, a.k.a. the Futures Industry Association, a.k.a. the folks who kind of keep track of all the global derivatives volume, futures and options around the world, they just released, right before the show, their breakdown for the first half of 2021. And I happen to have it here in my hot little hands. So, Elicias, this is for you and everyone else out there who's intrigued. FIA, again, they track everything that goes up around the globe. And they say, first off, region-wise, from a regional perspective, the Asia-Pacific region, those exchanges had the largest overall increase in trading volume over the first half of this year, followed by Latin America. In terms of North American exchanges, the number of contracts traded on North American exchanges, again, that's combined overall derivatives, so combining futures and options together, grew by almost 15.5%. Volume on European exchanges fell by nearly 12%, and that's all compared to the first half of 2020. So where we stood a year ago, versus now. Overall, breaking it down even further by an asset class perspective, it's equities. That's driving the machine, not just here in the U.S., everyone piling into their meme names and everything else, but around the world. Equity markets are contributing the most, they say, to the global surge in trading activity. A trading volume of single stock futures and options soared 72.5% to nearly 3 billion contracts this year, 2.97 billion. And equity index futures and options volume also rose 32% to 2.82 billion contracts. That's a heck of a lot of paper. So the equity story, not just a U.S. story, listeners, it's happening around the globe. In terms of rates, where we kicked off our show today, volume in rates, futures, and options fell 4.2% to 2.33 billion contracts. So still very active, but obviously equities surpassed them. Remains below pre-pandemic levels, which is interesting. But open interest, surprisingly, increased by nearly 11% to 190 million contracts. It's a sign that market participants have increased their exposure to rate risk compared to a year ago. Trading activity in most commodity markets, they mentioned as well, rose by double digits. The only exception, one of the hot ones people like to talk about on this show, was energy, with both volume and OI down from the first half of last year. In terms of the top exchange groups around the world, the National Stock Exchange of India continued to have the highest trading volume, 6.6 billion contracts traded in the first half of the year. That's up nearly 77% from this time last year. OI, though, again, kind of a strange counterbalance there. The OI is still pretty low. Only 14.6 million contracts open at the end of June. So there 6.6 billion contracts changing hands. It's up 77%, but only 14.6 million contracts open at the end of June. Sounds like a lot of churn and burn going on out there. And the NSE, Brazil's B3, number 2, the second largest global exchange by volume. Their volume up 52.2% to 4.16 billion contracts. OI, though, again, actually a little bit more active, obviously, than India here. OI still dropped, though. It dropped to about 148 million contracts at the end of June, but relatively high compared to what we're seeing over there at the NSE. CME Group is number 3, with about 2.5 billion contracts changing hands in the first half of this year. That's actually down about almost 10.5% from the first half of last year. OI, about 103 million contracts at the end of June. That's pretty much unched from where it was this time last year. So a great question, Elysius. Short answer is yes, we do break that down, but it's included in the overall numbers. Longer answer is check out that report. I just gave you the highlights, but a lot of great analysis. If you want to see what's going up around the world, then that report is a great place to start. All right, everybody. That music, you should be hearing it if you're listening live too. That music means we've come to the end of the road. Looks like I survived here. This looks like it's storming pretty hot and heavy out here outside the Southern Studios, but I survived without getting kicked off, which is nice. But before we go, Mr. Uncle Mike, if folks are intrigued, they liked what you were talking about today with rates or silver, any other products out here, and they want to reach out to you to discuss them further, where should they go? What should they do?
There's 2 ways in which you can reach me. First way, follow me on Twitter at Mike TOSAW, TOSAW, or check out my website, stcharleswealth.com. I'm a financial advisor, and I use the option product very frequently, assuming everything is kosher and everything makes sense for the client.
So you're the guy to call if someone wants to pick up some of those set par calls in silver. That's what you're saying.
I'll sell them some, sure.
Yes, there we go. Check it out for yourselves. stcharleswealth.com is the place to go. You know where to go. Check out all those reports from CME. CMEgroup.com/TWIFO is the place to go to kick the tires and light the fires. Of course, once you're there, you can also check out all the great stuff from Eric and the research team over there, the education, and a whole bunch more. But it begins, your journey begins at CMEgroup.com/TWIFO. And of course, you know where to go for all the analysis, what's going on, what some of the ramifications of recon, what's going on from a small cap versus large cap vol perspective. How is the pandemic impacting small caps versus large caps? A whole bunch of that and a whole lot more. You know where to go. FTSERussell.com, FTSERussell.com is the place to go. Give them a follow on the old Twitters while you're at it. At FTSE Russell is the place to go for all that info in between episodes of this fine program. On behalf of everybody over there in FTSE Russell land and CME land and Uncle Mike and indeed myself, I want to thank all of you out there for downloading and streaming and subscribing, and for the hardy ones of you out there in the secret club who joined us live this week. We'll see you all back here tomorrow, noon Central, 1 p.m. Eastern for Vol Views, and afterwards for Options Oddities. I got a sneaking feeling maybe some of that silver may make it in there. And then we're back again next week with another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.